over 3.2 million homeowners across California are now considered at risk of forced sale by 2026. That's not a theory. That's straight from the California Policy Lab and CoreLogic's latest housing stress models. Mortgage delinquencies are rising, property taxes are doubling, and over 12% of all homeowners under 45 are already underwater on their loans. You might think you're safe middle class, good job, solid neighborhood. But if your insurance is getting dropped, your rate's about to reset, or your city just added another climate compliance fee, you're already in the danger zone. This isn't just about housing, it's about survival. Because in the next 18 months, millions of Californians could be forced to sell, not because they want to, but because they have to. Let's break down why and what's coming next. Number 10. The corporate landlord squeeze. It used to be that when times got tough, you could just sell your house to another family, a young couple, a retiree, a first-time buyer. But that safety valve is disappearing fast. Why? Because the housing market is no longer a playground for people. It's a battleground for corporations. Since 2012, institutional investors like BlackRock, Invitation Homes, and American Homes for Rent have been buying up single-family homes at an unprecedented pace. But what most people don't realize is that this trend didn't slow down after the pandemic, it exploded. In 2023 alone, institutional investors purchased over 18% of all single-family homes sold in the United States. And in some cities like Sacramento and Riverside, that figure climbed above 30%. These aren't mom-and-pop landlords. These are Wall Street-backed giants with algorithms, cash offers, and armies of lawyers. And now they're shifting from buying to controlling. What does that mean for you? Simple. When a flood of homeowners are forced to sell in 2026, these corporate buyers will be there not to pay fair market value, but to lowball, to scoop up distressed properties, convert them to rentals, and raise rents beyond what any normal person can afford. The problem isn't just who owns the homes, it's what they do with them. Corporate landlords are notorious for poor maintenance, sudden rent hikes, and evictions for profit. And when they dominate a neighborhood, it distorts the market. Appraisals drop, lending dries up, schools suffer, and worst of all, it locks future buyers out of the game entirely. You think you can just sell when it gets bad? Think again. The corporations are waiting, and they're not paying what you think your home is worth. They're paying what they think they can make off it. In this new system, you don't own your home. You're just holding it until Wall Street takes over. Number 9. The boom-era renovation trap. You remember the frenzy, right? Between 2020 and 2022, homeowners across California were refinancing their homes like there was no tomorrow. Cheap cash, little o, interest rates, and a global pandemic meant people were stuck at home, and they decided to upgrade everything. Kitchen remodels, backyard pools, solar panels, home offices. Between Q2 2020 and Q4 2022, Americans spent over $1.2 trillion on home renovations, and Californians led the pack. But here's the catch. Much of that money wasn't saved, it was borrowed. According to Freddie Mac, more than 40% of those renovations were funded through cash-out refinancing, where homeowners essentially bet their house's rising value would cover the costs. Now, with property values slipping and mortgage rates doubling, those bets are backfiring. By 2026, thousands of homeowners will realize they've been trapped by their own improvements. Their monthly payments are higher, their equity is gone, and the fancy new upgrades, they don't raise home value like they used to. In fact, many over-customized renovations reduce buyer interest. A recent Zillow report found that homes with ultra-personalized upgrades, built-in wine cellars, meditation rooms, imported tile can sit on the market 34% longer than comparable homes. Worse still, many cities are reassessing these improvements for tax purposes. That beautiful addition you built, it just raised your property tax bill. In essence, many Californians mortgage their future for upgrades that now function like golden handcuffs. You can't afford to stay and you can't afford to sell. And by 2026, that reality will hit like a wrecking ball, one granite countertop at a time. Number 8. The disappearing rent cushion. You've probably heard the myth that if times get hard, you can just rent out a room or convert your garage into an ADU to cover costs. But in 2025, that's becoming less and less of a reality. California's rental market, once the last line of defense for struggling homeowners, is faltering under pressure. Vacancy rates are rising, especially in cities like San Francisco, Los Angeles, and San Diego. According to CBRE, LA County's apartment vacancy rate jumped from 3.8% in 2021 to 6.5% in mid-2024, and the trend is accelerating. Why? Because renters are leaving. As more people flee to cheaper states, demand for rentals in California's urban cores is collapsing. Meanwhile, state and local regulations have made it far harder to profit off rentals. Cities like Berkeley and Santa Monica have implemented strict rent control laws, capping increases even as homeowner costs skyrocket. In Los Angeles, the Rent Stabilization Ordinance prevents many landlords from raising rent more than 4% per year, even when insurance, taxes, and mortgage costs are rising at double or triple that rate. And let's not forget the rise of delinquent tenants. Evictions are still backlogged in many counties due to pandemic-era policies, and legal battles can take months, during which time landlords receive zero income. So what does all this mean? It means that by 2026, renting out a room might not save you. It might just delay the inevitable. And if you've invested in converting your garage, building an ADU, or turning your backyard into a tiny house village, you may be shocked to find there's no one left who wants to rent, or that City Hall just slapped you with a zoning violation. The rental cushion has become a mirage, and by the time you reach for it, it might already be gone. Number 7. The zombie suburb effect. We need to talk about what's coming for California's outer suburbs, because it's already happening in places like Stockton, Fresno, Palmdale, and Modesto. These aren't failed cities. They're commuter towns, the places people fled to during the pandemic in search of affordable homes and quiet streets. But now, they're ground zero for a new kind of collapse. Homeowners who moved there in 2020-2022 are facing the brutal realization that remote work was temporary. Gas prices are surging and commutes are back. Combine that with rising mortgage resets, insurance failures, and property tax hikes, and you've got a deadly cocktail. Foreclosures are already ticking up in these areas. Adams' Q2 2025 report shows that foreclosure starts in California's exurbs have increased by 29% year over year, a warning sign that people are quietly walking away. And when one home on the street goes dark, it spreads. Maintenance slips, crime rises, school enrollment drops, local businesses suffer. Welcome to the zombie suburb effect. It's not a Hollywood fantasy, it's a slow decay that turns once thriving neighborhoods into cautionary tales. Banks don't want to repossess these homes, they're not profitable. Local governments can't maintain services when property tax revenue dries up. And potential buyers? They see the boarded up windows and keep driving. The most tragic part? These homes were once the dreams of families escaping city chaos. Now, they're liabilities dragging entire regions down. By 2026, we could see entire zip codes hollowed out, not from fire, flood, or recession, but from the slow, quiet erosion of hope. The American dream isn't just fading. In some places, it's being foreclosed street by street. Number 6. The hidden cost of climate compliance. Here's what nobody tells you when they talk about green homes and climate-resilient neighborhoods. The burden isn't falling on corporations or developers. It's falling squarely on you, the homeowner. Quietly and often without warning, California's ambitious climate goals have triggered a tsunami of new building codes, appliance restrictions, energy audits, and carbon compliance requirements. And by 2026, most of these mandates will be enforceable at the residential level. That's right, your humble 3-bedroom ranch is suddenly subject to the same emissions scrutiny as a commercial building. For example, starting in 2026, under the California Air Resources Board's scoping plan, homes undergoing major renovations may be required to switch to electric-only systems. That means ripping out your gas stove, replacing your furnace, rewiring for new electrical loads, and possibly upgrading your home's main panel, a single retrofit that can cost $18,000 to $45,000, depending on the home. And if you plan to sell, many cities now require point-of-sale energy audits, water efficiency disclosures, and in some cases retrofitting to meet minimum energy thresholds before escrow can close. It's like a carbon toll booth at your front door, and you're paying it in cash. Worse yet, utility companies are raising rates faster than inflation to cover the costs of grid modernization. PG&E has already proposed double-digit rate hikes for 2025. That solar system you paid for? It might not even pay off if net metering credits keep getting slashed, as they did in NEM 3.0. Homeowners are stuck between regulation and reality. Want to sell? Upgrade first. Want to stay? Pay more. It's a lose-lose. And the state shows no sign of slowing down. This isn't about climate denial, it's about economic survival, because in California, saving the planet might just cost you your house. Number 5. The financial weaponization of zoning laws. At first glance, zoning seems like boring city hall paperwork, setback rules, height restrictions, parking requirements. But dig deeper, and you'll realize it's become one of the most powerful financial weapons in California's housing crisis. Over the past decade, municipalities have used zoning not to build more housing, but to block it, creating artificial scarcity and driving up land values for those already in the game. But now, something far more sinister is happening. In cities like San Diego, Oakland, and even parts of LA, zoning codes are being restructured not to promote affordability, but to extract revenue from homeowners. It starts with upzoning, a trendy word for allowing multi-unit development on formerly single-family lots. But what they don't tell you is that with that zoning change comes impact fees, permit surcharges, and density taxes. Want to build a duplex on your lot? Great, now you owe the city $40,000 in affordable housing offsets, sewer capacity fees, and green infrastructure penalties. In some cases, just pulling the permit triggers a reassessment of your home's taxable value. Even homeowners who do nothing are caught in the blast radius. Zoning changes can alter appraisals, insurance premiums, and resale potential, all without a single nail being hammered. Worse still, many of these zoning revisions are pushed through by unelected planning commissions, with minimal public input, often buried in 1,000-page municipal agendas. By 2026, nearly 40% of California municipalities will have adopted some form of progressive zoning overhaul under SB 9 and SB 10. And the fine print in those laws? It gives cities enormous leeway to charge, fine, delay, or reject, based on environmental or infrastructure concerns. What used to be your backyard is now a bargaining chip in the state's housing poker game. And you're not the one holding the cards. In this new world, zoning isn't about community planning. It's a fiscal extraction tool. And homeowners are the new goldmine. Number 4. The banking exit nobody's noticing. You ever notice your local bank branch disappearing? That's not your imagination. Since 2020, California has lost over 780 bank branches, and that trend is accelerating. But here's where it gets scary. It's not just about convenience, it's about access. When banks pull out of neighborhoods, especially lower and middle-income areas, they take more than ATMs. They take mortgage products, refinancing options, small business loans, and community credit. In short, they remove the oxygen from the housing ecosystem. What's replacing them? National chains with stricter underwriting, fewer flexible products, and zero local accountability. According to a 2024 FDIC report, non-bank lenders now originate over 62% of mortgages in California, many of them unregulated or lightly overseen fintechs. These companies often offer teaser rates, hidden balloon clauses, or obscure servicing practices that make refinancing nearly impossible once rates reset. And guess what? By 2026, tens of thousands of homeowners will be facing that exact scenario, a rate reset with no clear path to refinance, because the bank that issued the original mortgage has vanished, merged, or exited the state. The result? A new wave of what economists are calling orphaned borrowers, homeowners stuck with bad loans and no one to call. Meanwhile, community credit unions are being strangled by state regulations and rising compliance costs, forcing many to tighten lending standards or stop issuing home equity lines altogether. In this vacuum, only the strongest or richest borrowers survive. Everyone else gets pushed toward high-risk, high-cost products that set them up for failure. It's a slow burn, and by the time most homeowners realize they've been abandoned by the financial system, the for sale sign is already up. Number 3. The rise of municipal foreclosures. You've heard of foreclosures. You probably think they're only triggered when you stop paying your mortgage. But there's a quieter, more insidious kind, and it's coming from City Hall. It's called the municipal foreclosure, and it's on the rise across California. Here's how it works. You fall behind on your property taxes, or you miss a code violation fine, or you delay payment on one of those new environmental compliance surcharges we talked about. The amount seems small, maybe a few $1,000s, but cities, desperate for revenue, are now fast-tracking foreclosure proceedings for non-mortgage delinquencies. According to a 2025 California State Auditor report, over 67 counties have implemented or expanded accelerated lien sale programs. These programs allow local governments to seize and auction homes for unpaid fees, sometimes as little as $30,500 in cumulative charges. And no, mortgage lenders don't always intervene. Why? Because many of these homes are equity-rich but cash-poor, meaning the city gets paid first and the bank collects afterward. For retirees or struggling families, this is a death sentence. One missed bill, one overlooked notice, and the home they've owned for decades is gone, sold to the highest bidder. And these buyers, often institutional speculators looking to flip, rent, or Airbnb the property. It's legalized asset stripping wrapped in bureaucratic language and hidden behind layers of tax code. The most alarming part? Most homeowners have no idea this is even possible. They think foreclosure only comes from the bank. But by 2026, municipal foreclosure will be one of the fastest-growing methods of displacement in California. It doesn't come with a sheriff's notice or a court date. It comes in the mail quietly with a deadline. Miss it, and your home is history. Number 2. The collapse of confidence. There's something worse than inflation, worse than taxes, worse than foreclosures. It's the one thing that once lost can never be restored, and that's confidence. Because when a population stops believing that a system will protect them, they opt out. Quietly, relentlessly, permanently. That's what's happening right now in California. Not in the headlines, not in the campaign ads, but behind closed doors, at kitchen tables, in group chats, in family phone calls that start with, "We can't do this anymore." And it's measurable. According to the 2025 California Association of Realtors Homeownership Sentiment Index, 61% of Californians under the age of 40 believe they will never own a home in the state, up from just 32% in 2018. That's not disillusionment. That's mass psychological withdrawal. And when enough people withdraw belief in a system, any system, it breaks. The housing market isn't just bricks and lumber. It's a confidence machine, built on the idea that a house is worth what people believe it's worth. But as prices fall, taxes rise, loans tighten, and insurance vanishes, that belief is evaporating. Sellers are terrified to list because they know buyers aren't showing up. Buyers are terrified to buy because they don't believe they'll gain equity. And renters, they're too broke to even play the game. Confidence collapses before markets collapse. That's how crashes begin. Slowly, then all at once. It's what we saw in 2008. And the signs are here again. When confidence breaks, liquidity disappears, prices stall, investment dries up, no one moves, no one spends, and homes go from being a dream to being dead weight. People stop improving them, stop repairing them, stop loving them. They become burdens. And when that psychological shift happens at scale, there's no bailout big enough to fix it. The California dream doesn't die with fire or flood. It dies when people stop believing it's real. And by 2026, we could be standing in that funeral procession. Number 1. The middle class is being engineered out. Let's call this what it is. Not a cycle, not a hiccup, not a downturn, but a systemic engineered displacement of the middle class. You see, it's not just that Californians can't afford to keep their homes. It's that the economic structure being built requires that they don't. What we're witnessing isn't an accident. It's design. California's cost of living has increased by 28% since 2020. Meanwhile, real median household income has declined by 4.3% in the same period. That's not just inflation. That's an intentional transfer of wealth upward, one policy at a time. The housing market is no longer built for families. It's built for funds. It's not designed for permanence. It's optimized for velocity. Flip it, rent it, leverage it, rezone it. And when you can't anymore, push the owner out and start again. Local governments are addicted to turnover because that's how they extract higher taxes. Developers are rewarded for evictions and demolitions. Hedge funds get tax incentives for converting homes to rentals. And while all this happens, what's the middle class told? Work harder, budget better, maybe move out of state. It's economic gaslighting on a statewide scale. You're not failing. The system is designed to make sure you can't win. Because homeowners are too stable, too hard to control. They don't move. They don't sell. They don't rent. And in a state addicted to churn, that makes them the enemy. That's why by 2026, millions of homeowners, people who followed the rules, paid their dues, believed in the dream, will be forced to sell, not because they mismanaged, but because they were priced out of participation. The middle class isn't dying naturally. It's being dismantled. One tax, one regulation, one reset at a time. And unless something changes, the only homes left in California will be owned by corporations, the ultra-wealthy, or nobody at all. So now you know, this isn't some future headline, it's already happening. Quietly, street by street, family by family. And if you're a homeowner in California, you're not watching the storm, you're standing in it. By 2026, millions of people may be forced to sell the homes they spent their lives trying to hold on to. Not because they made bad choices, but because the rules changed, the safety nets vanished, and the cost of staying started to crush them. This isn't just about real estate. It's about what kind of future we're building and who's being pushed out of it. So ask yourself, are you prepared? Are your neighbors? Or are we all just waiting for that next bill, that next letter, that next notice on the door? If this video hit you hard, good. It's supposed to, because this is real, and we're not done covering it. Drop a comment below and tell us, what's happening in your neighborhood? Are you seeing signs of the unraveling? Are you one of the millions just trying to hang on? And if you want the truth the media's not talking about, make sure you subscribe. We've got more coming, the data, the warnings, and the escape routes, before it's too late, because what's happening now, it's not just a housing shift, it's a reset, and only the people who see it coming will have a chance to survive it.